Hello there everyone, today's video is all about the lifetime allowance. So this is to do with pensions, specifically the limit in terms of the size of the pension pot that you are allowed before you are penalised for extra tax. So let's just think through how the system for taxation of pensions works in the UK. Basically you get tax relief on the way in. So tax relief against your income on pension contributions into your pension pot can be from your personal income or from your company profits, a corporate tax deduction. And once the contributions are in the pot, they grow free of tax. So tax relief on the way in, grow free of tax, but the quid pro quo from the government is at the back end, i.e. when you come to take the pensions, what we call a benefit crystallisation event, you then start paying some tax. So you've got tax relief way back when you put the money in, tax-free growth, and then at the back end you start paying some tax. Yes, you do have tax-free lump sums in some cases, maybe 25% of the pot, but most of the pot you will pay some tax. And also as part of this quid pro quo, you can't have a pot beyond a certain size because that again costs the government too much money. So they say, look, the size of the pot that you can have in your pension is £1,073,100. Now, why is it that? Well, it's just a random arbitrary figure that the government's actuaries, their maths bods who calculate how much they're going to be out of pocket on giving all this tax relief, they work out and they say, look, this is what it's going to be. Now, it started out the lifetime allowance, as a lot higher, closer to 2 million. And then the government brought it down and down. Now, each time they said that there was various protections on offer. And when we say protections, that you could lock in the higher lifetime allowance before it was reduced to the lower amounts. But by and large, those protections to increase, to maintain the original size of your lifetime allowance have now gone. So let's just assume now that everyone's at this arbitrary figure, this 1 million. By the way, this was 1 million plus the CPI rate of inflation 2 years ago, and it stayed there. So that's the magical number that you don't want to have in excess of in your pension pot at the time that you start to crystallize the benefits. So when do we actually, if you are in your 40s or your early 50s and you're nowhere near starting to access the pension, and the value of the pot, because you can work out pretty much on defined contribution pots how much is in there, if you exceed this number, all is not lost, because it all depends on what happens at the time of the benefit crystallization. So that's the time you start to access the money, which if you're over 55, you may start to think so. But certainly if you have exceeded it before you get to that benefit crystallization event stage, nothing to worry about, because of course the value of the pot could come down. It's invested in the markets. You may dip back under the threshold by the time you come to take the pension. So we test to see if you busted the limit. Number one, benefit crystallization when you start to take the benefits. And number two, on your 75th birthday, that's the other time that you would test to see if the pot has been exceeded. So I would suggest most people have started a benefit crystallization event before their 75th birthday, but you don't know, because pensions now are good for inheritance tax purposes. A lot of wealthier individuals will use pensions just as an inheritance tax planning tool to pass on to the next generation without having any intention of accessing the pot. I've done another video on that. So what happens then? What is the charge when you bust this magical figure of just over £1 million? What is the tax charge? Well, two different types of tax charge. If you leave the money in, let's assume just on the excess now, the excess over this limit, if you leave the money in your pot, you're going to be hit for 25% tax. 55% if you take it out as a lump. So let's just crunch some numbers here, do some maths. Let's assume you've exceeded this lifetime allowance by £1,000. £1,000 is the excess, so you'll be taxed. The pension fund, 25%, so that's £250 of tax. £750 remains in the pot. Then later, this is taken out. Let's say the individual chooses a drawdown method. There's various methods you can take out your pension by annuity, drawdown, flexible drawdown. So this individual, at a later stage, takes the money out as an income, and they are a higher rate taxpayer, so they pay 40% of the 750. So they are left with a net amount of £450. So remember that they started out as 1,000. 25% tax in the pension fund leaves us with 750. 750 at 40%, which is £300 tax for the individual, means that the individual is left with £450 in their pocket. So that is an effective rate of tax, if you will, combined on both events, 55%. Started with 1,000, end up with 450. That's a 55% tax charge. Option 2, they just take the money out as a lump sum. So rather than as an income, they say that £1,000 and take it out as a lump sum. That's when the straight 55% tax comes in. So the individual has 55% tax charge on that, and they're left with £450. Again, it's the same result. So in either case, you pull it all out as a lump sum or leave it in and invest it and then draw it down as an income later. It's the same result, £450 in your pocket at the end of the day. However, bit of planning here. What if you're not a higher rate taxpayer in retirement? What if instead you are not a 40% taxpayer, but a 20% taxpayer? If all your income in retirement, your pensions, whatever you've got, is less than 50 grand a year, there or thereabouts, you will pay 20% tax, not 40%. So in that case, if you're a basic rate taxpayer, the tip would be, don't take this £1,000 out as a lump sum, but rather option 1, leave it in, invest it, take it down as an income later on, because the tax is totally different. 25% in the pension pot, but then when you pull it out, 20% tax, 20% instead of 40%. So that obviously saves 20% of, so that saves you 150 quid on that £1,000 slice of pension monies. So you're saving a decent whack by not pulling it out as a lump sum, but having it as an income later on. So that's just a bit of planning there. If you have an issue with a lifetime allowance at the point of a benefit crystallization event, i.e. when you want to get your hands on the money, but you are over this arbitrary lifetime allowance threshold of just over £1 million, think about your options. You don't have to take it out as a lump sum. If you do, it's going to be taxed at 55%. But if you are a basic rate taxpayer, consider leaving it in, drawing an income from it, and then you will be subject to the lower rate of tax, because it'll be 25% in the pot plus 20% of the balance. So you'll be better off. So just an overview there on lifetime allowance for pensions. If you like this video, please do subscribe right about there, and I'll see you soon.